Hello everyone, this is Datatraderpro. I wanted to do a quick video to discuss some things we've discussed in the trading room. Those who have been around a little while have heard me discussing these ideas before about notional value of E-Mini futures contracts and how they've changed over time, and how it would be a great idea to have a smaller E-Mini future. And guess what's happened? The CME was listening. They've introduced recently the micro E-Mini futures, and I just wanted to discuss that and why I think there are a lot of advantages for both newer traders and small account size traders and small lot traders, which makes up actually probably the vast majority of futures traders out there are small lot traders. You can see that witnessed in the book and the time and sales, but how many 1 lots and 2 lots are executed. Also backed up by CME statistics. So anyway, yeah, let's get right onto it. They're a new product. And what are they? Basically, they are 1/10 of a regular E-Mini, whether that's ES, NQ, YM, or RTY. How did these come about? Well, originally, the futures for indexes were called S&P, and they were traded in a pit, an open outcry is what it's called. And they had that all futures have a multiplier, a value times the base, whatever it is. So oil is $1,000 a barrel. So CL's value is $1,000 times whatever a US dollar price per barrel is for oil, right? So it has a notional value of, if it's trading at 55, it's 55,000, right? Well, S&P, the big S&P contracts have started out with I believe it was a $500 multiplier and got cut in half, if I remember correctly, down to $250. So it was 250 times whatever the S&P price was at the time. When the E-Minis came out, ES, that is, I think it was about 1997 they came out. And it came out when it was getting popular that people were starting to get personal computers at home, and well, certainly before that, but very popular with Windows, and people could trade electronically, and you didn't need to be a CME member and have a badge and a funny looking jacket to go trade in the pit, and a lot of money, because when you're trading a $250 multiplier. I mean, if ES or if S&P 500 price was at 1,000 at the time, let's say, then the big S&P contracts would be $250,000 notional per contract. So every time you put up your hand, it was to a minimum of $250,000 of index you were trading. So as you can see, obviously the margins are much less than that, but we'll talk about that later, margins versus notional, right? So so ES has a $50 multiplier, NQ has a $20 multiplier, and so on, right? So and that's per index point. That's why 1 point of ES is a $50 move, right? Mini ES, MES, has a $5 multiplier. It's 1/10 of an ES. So ES is 1/5 of a big S&P, and micro ES is 1/10 of ES. Yeah. So why did we go from the big contracts to E-Minis in the first place? Well, a lot of advantages, some of which we talked about already. You can trade anywhere with your computer. You didn't need to be a member. You didn't need, this and that. Actually, if you weren't a member, the only way you could trade before was through a broker, and a lot of the guys in the pit were brokers. They would trade their own accounts, and they would also trade customers' money. So you'd have to pick up the phone and dial somebody and place an order, and you got filled where you got filled. And a lot of these guys would fill themselves first at a better price and maybe sell them back to you, or somebody else, you get caught up in a liquidity sweep or something like that, and you get filled wherever you got filled. E-minis, you could see the price yourself live, and you could execute where you thought was advantageous. Also, obviously, being 1/5 the size, there was quite a bit of increased liquidity. It opened up markets to a lot of people, not just the pit traders. So liquidity increased, and also the entry value was quite a bit lower. So, increased liquidity, lower cost, can trade from anywhere. Boom, you had a winner, right? So let's talk about that notional value idea, right? When you're trading a futures contract, a lot of people talk about margin, especially newer traders. And how much money do I have to have in my account so I can trade one contract? And on, let's say on ES, the margin at most brokers, is $5,000, say, to hang on to a contract. And intraday margin is between $500 and $1,000, depending on your broker, how much risk they're willing to give you. Yeah. So that's a lot of leverage, margin versus notional value, because right now, let's just use a nice round number. ES isn't quite there, but let's say at 3,000, S&P or ES, that contract has a nice round notional value of $150,000. So it's grown quite a bit, right? So the ES low of March 2009 was 666. And it had a notional value of about $33,000 roughly, right? So we've gone from, in 10 years, in a decade, we've gone from 33,000 to 150,000, almost 5 times the amount of notional value. But that's trading with a single click, a single lot, a single contract, or sometimes called a CAR. Single CAR has increased 5 times the notional value. So you can see that you're trading a lot more with a single click of a button, right? And NQ at 7,700, which it's at roughly, has a notional value of, I think it's 154,000, right? If I'm doing the math correctly in my head. So these E-Micro Index Futures are a way to bring the notional value back down to reasonable levels. Also, hopefully, increase liquidity, increase trader participation. Remember that as traders trade, small lot traders and small account size traders tend to blow out a lot, right? So they'll fund an account with $10,000 or $20,000, and they'll get stopped out a number of times, and whether it takes months or a year or whatever it is, and especially new traders, they'll blow out. And that might be a good thing for people on the other side of their trades, but it's actually not really great for the exchange. Losing traders is losing customers, and losing customers is losing income, right? So if you have a lot of people blowing out, it's not necessarily good for the long-term health of your business, right? Even though algos in the past 10 years or something have picked up a lot of that business, I suppose, but you want the participation of a broad number of people. You don't want just 2 computers fighting it off against each other. You want lots of participants, right? Spending money, because the CME makes money off every contract that trades. So the more people trading, the more contracts trading, the better it is for them. It's also a more level and even playing field for new traders, because they can get in a lower risk environment, etc. So let's talk about some other aspects. It's not really unusual to have micros. I mean, it's new for indices, but there are already many micro contracts, such as micro gold, which is MGC, on COMEX, which is also part of the CME. Microcurrency futures, like the micro euro, which is very popular and liquid. It's 1/10 of a regular euro, and you know that all those the microcurrencies, there are microcurrency futures for every regular currency future, and they're all 1/10 the size. Some of them are not very liquid, but the euro is, I think maybe a couple of more, like the micro Japanese yen is okay, I think, and then it tails off. I mean, I don't think there's a lot of people trading the micro Canadian dollar or something like that. But anyway, yeah, and then there's a host of other smaller contracts, such as half-size oil, I think it's QM, it's called, a quarter-size natural gas, which is QG. So this is not like a brand new thing, right? It's been happening for a long time with other commodities and other products, yeah? So, I believe this is the beginning of a more standardized set of micro contracts, now that it's come to the most popular contracts, which are the indices. I think that will be the new standard. That pretty much everything going forward will have a 1/10 micro, at least from the CME, because it makes a lot of sense, right? So, yeah. So let's talk about some of the pros over regular E-minis. We'll get into a little bit of charting and stuff in a moment, but and I'll draw a few things out. But basically, they're scalable. So you can learn to scale in and out of trades like many pros do, but with a much smaller account. So, yeah. So they're fully fungible with E-minis. So that means if you buy 10 micro ES and sell 1 ES, that means they're fungible, right? So they're exchangeable, they're tradable with the regular E-minis on a 10-to-1 basis, right? The smaller size account allows new traders to experiment with trading with skin in the game versus sim trading. And I believe, personally, it's impossible to maintain the same set of rules and discipline with sim trading versus a real money account, right? So, and the reason for that is all psychological. So, when you're down and you've lost money, you have a totally different outlook, especially newer traders who have emotional reactions. You can feel your face getting red and your blood pressure rising and all these kinds of things. One of the keys to learning to trade well and make money consistently is to take emotions off the table. And any way that you can do that, whether it's playing, elevator jazz music in the background, whether it's watching YouTube cooking videos while you're trading, as long as you don't get too distracted. Any method you can use to sort of reduce your emotional component of trading and maintain your psychological capital no matter what the market's doing. That's extremely important to the survival of your account and your continued success as a trader. So that is much more easily maintained with micro futures because you can scale in and out. You don't have to take a big position for your account size. I mean, really, a lot of people are trading, where, like we said, ES is worth roughly $150,000 notional, and they're trading, one contract with a $5,000 or $10,000 account, right? So that's a lot of leverage, right? So, I mean, if a black swan came out of the blue, you'd be wiped out immediately, right? So, yeah. So, a number of other reasons. Low commissions, and by low, I mean, I guess overall, if you traded 10 instead of one lot, you'd be paying more commissions than just the one E-mini. But, it allows you to do something unusual and interesting, which is something like trading half a lot or trading 6 or 8/10 of a lot or 2/10 of a lot or whatever you want to trade. And it's a great way to learn trading without, a huge amount of risk, also maintaining low commissions. If you compare the commissions you would pay on E-Micros to, say, stocks, which a lot of brokers have flat rate pricing, especially the real retail brokers, sort of go after people with these sort of $10 a trade. So, you know, $9.99 a trade or something, and it used to be a heck of a lot more than that. But you know, a lot of them are doing something like that, like $9.99 a trade, $10 a trade, let's say. But if you want to scale in and out of positions with small, you know, sizes of shares, you know, and you're buying two or three tranches of you know, to fill your full position, then you can spend $30 on the way in, and as you scale out, $30 on the way out. So you've just committed $60 to trading, no matter what the outcome is, whether you win or lose or whatever. You're going to, you know, your broker is going to be happy. You know, whereas, you know, I think I'm paying 32 cents a side now with my broker for a E-Micro. So that means 64 cents round trip, which is $6.40 equivalent to an ES contract. Now, with the same broker, I pay about $3.70, $3.80, something in that area. So it's definitely more. But, you know, relative to what you're doing as compared to a lot of options trades or stock trades, depending on your broker, your account size, the amount of volume you do with that broker, you know, because these things are negotiable within reason. Yeah, you can save a lot of money, right? And you have direct exposure. You don't have the, you know, a lot of smaller lot traders trade options, and because of the, or smaller account size traders, I should say, trade options, and because of the limited risk, and it's also because they just don't have a lot of money, and because they don't have a lot of money in their account, they go for short-term options, and short-term options meaning this week, next week, right? So there's a huge amount of decay in those options, right? So, you know, getting in and out, timing is everything with those kinds of things, and it's much easier to do with a futures contract than an options contract, right? So you don't have that decay. You can take it out to longer expirations because they're all quarterly, just like you know, the E-minis are quarterly expirations. Also, you get less stop outs. I mean, if you take a position where you're scaling in, or you're just a smaller position overall, you can have wider stops. And why would you want wider stops? A lot of people may disagree with me here. It's asking me to sign in. No, I don't want to do that. I just want to reload it. I'm not signed into TradingView. Maybe I can get away with it. Yeah, so if you trade something like NQ, you know, ES is fairly smooth moving except when you get news, but NQ is a relatively volatile contract, right? So it's what they call high beta. It's based on tech stocks, which generally outperform most other stocks. You know, on a 1% update in indexes, a lot of tech stocks, individual stocks will be up 2, 3, 4%. You know, et cetera. So NQ is representative of the, you know, groups of those stocks mostly, and so you'll get a lot of stop outs. I mean, you know, if you think you bottomed here, for example, with these candles, you know, and you know, maybe you want to start scaling into a move for the next long opportunity, or down here somewhere, it's very easy to get stopped out. And if you're a small account, small lot trader on NQ, and you have, you know, what are your stops going to be? Where are they going to go? Usually, you're going to base your stops on how much money you want to risk on the trade. It's like a gambler saying, you know, I'm going to play blackjack and I'm going to stick to the $5 table or the you know, $20 table or whatever it is. So, you know, and that ends up, you know, grinding you up a lot of times, because you'll take multiple stop outs. It'll bottom lower than you think it's going to be, and then it goes the way you thought it was going to anyway. But by then you've beat yourself up mentally and emotionally. You've stopped out a number of times. You've hurt your account. You're probably at your daily loss limit. You're angry, and you're starting to wonder if trading is for you after all, right? So I've been there. You've all been there, I'm sure, at some point. But this is a way to avoid it. So if we're going to use an example, you know, from this guy. I don't know, maybe I can do a drawing on here. Yeah, I don't know. Maybe I'll do a little rectangle. So if you if you like this as a low, you know, this area, and you were wrong, right? And you know, most people on the full size contract, small lot traders, will get stopped out through this chop, right? It'll make that one more low, like it does a lot of times, and sometimes 2 or 3 more lows. You know, it tends to stop people out, and then it goes up and down and up and chops around, and then you get a big move. So, you know, it allows you to put your stops, you know, wider stops. So maybe you start with 1 or 2 contracts, right? And this, you know, if you like this as a low, maybe you just start with 2. Like, let's say you want to trade the equivalent of 1 lot, and you start with 2 here, and as it moves down against you and then hits this low and then chops around, this is the zone where you start adding your size back in, right? Because it makes a new low, but look at the wick on it, and it pops back up, and it does this a couple of times. It spikes low and pops back up, spikes low, pops back up, spikes low, pops back up, and this is all telling you that, you know, the market's absorbing every push down. The market's absorbing it, and, you know, with size, and people are buying these lows, right? So generally, you can take the approach where you start with a speculative small size trade and then scale in, and then basically your average isn't up here. By the time you've filled your 1 lot, your average is somewhere in the middle. So you have a better overall position, and you can tighten up your stops when you achieve the full position to, you know, maybe a little bit under this low. You got 70.50 here, you got 69.20. So you're basically seeing a narrow range here, 72, 75, you know, 3-4 point range that it's trying to establish a low in. And this is the area where you want to add your size, because then you can take a fairly tight stop then, right? You've seen it hit the low, test the low, test the low, test the low, test the low, and if it's holding, it's probably going to make a significant move, right? The more times something, you know, in the market you test the low and it holds, or test the high and that holds, etc., you'll get a fairly strong move out of that. So that's the way I like to trade. I trade that way with the bigger contracts, but it's also, you can do the same thing with the micro contracts. It's a less stressful way to trade. It's a bit slower way to trade, because a lot of newer traders, when they've only got, let's say, 1 bullet in the gun, and you pull the trigger, it's got to go your way pretty quickly. Otherwise, you start doubting the trade. If it goes against you, stops you out once or twice, like we talked about, you start doubting the overall direction of the market. Am I right, or was this just your retrace and it's going straight down to a new low? You don't know that, right? So when you're trading 1 lot and you've only got, you know, 1 bullet, you know, in your musket, you have to be profitable on it, and fairly quickly, because, you know, more time in the market is more risk exposure, right? Anything can happen from here. So, you know, it's one of those things where, you know, you can also, because you one of the advantages of scaling in and out is that you can wait for it to hit levels on the way up. You know, if you're taking a long from this you know, accumulation zone, let's say, then, you know, then you want to hold at least up until these areas. Now, I didn't know that at this time that, you know, whatever, this was probably late after hours or something like that, but even still, you know, you don't know where you're going to get to, but any long is probably going to test this double high, right? You could say, whether you use pivot points or, you know, Fibonacci or whatever your thing is in trading, it doesn't matter. You know, you can draw out these levels, right? So there's no coincidence that this level was roughly the same as, you know, this level that held, right? So, you know, it's testing a low, and then, you know, it's making a move. It retested that high and dropped again, right? So, you know, any retest is probably going to come up to here, and any drop is going to test these double lows, right? So, you know, and therefore you establish structure and a trading range. So you know how to base future trades off and what levels to watch, right? So it's much easier to do with smaller size. You're not emotionally as invested in the trade, And like I said, the key is to become emotionally completely uninvested in the trades that you do. They're just trades, they're just setups. If you're wrong, shake it off, move on, wait for the next setup. Don't run back into the market immediately like a lot of people do and revenge trade. And you can do that much more easily with smaller size and less risk. So the few downsides of E-Micros are simply the increased commissions versus the minis. You know, it's not a massive amount of money, but if you really like trading your 1 or 2 lots and you trade a lot of them in and out, you're going to have increased commissions using the micros. And also, obviously, the smaller sizes mean less money in your favor with winning trades. So if you're going to trade half a lot and you've got a lot of winners, you're going to make half the amount of money if you hold for the exact same number of points, obviously. My feeling is that most traders will be able to hold longer with the E-minis or E-micros than the E-minis. So because, again, the psychological factor is in your favor. You're less emotionally invested, you're less scared, you'll panic less, you can wait longer on the upside when your trades are winners, because you're scaling in and out. So I think you probably end up skewing the risk reward in your favor substantially by modifying your trading to a more mature level, i.e. being more patient, holding on to winners, longer, that sort of thing, which are all goals that, most traders should be aspiring towards. So that's about it for me, really. I don't really have much to add on that. If you want to in the room comment on this or add any thoughts, I'd love to hear it. Otherwise, thanks very much for joining, and we'll talk to you soon. Bye-bye.